Hi there, it's Mike Kramer of Mott Capital. Today is Tuesday, March 26th, and it's around 4:30 New York time. So economic data will actually be picking up as the rest of this week goes on. Even though it is a shortened holiday trading week with markets closed here in the U.S., I know they're also closed in the U.K. on Friday for the Good Friday holiday. We're still going to have economic data here actually in the U.S. on Friday. So we're going to get GDP. We're going to want to pay close attention to the core PCE index quarter over quarter. Remember, this is not the same reading that we get on Friday, which is the PCE number month over month that comes out for the month of February. Initial jobless claims have also been something that the Fed has been paying attention to. Powell mentioned it at his press conference, and this is something that we're going to want to watch. Of course, pending home sales also will be important. We'll get University of Michigan consumer sentiment numbers and 1 year and 5 to 10 year inflation expectations. And then, of course, the big report will come on Friday morning with the PCE deflator month over month. We're looking for 0.4, up from 0.3. Year over year, looking for 2.5, up from 2.4. So headline PCE expected to be a little hotter. Core deflator month over month, 0.3% down from 0.4. Core year over year, 2.8 versus 2.8. So core is roughly down to slightly flat. And then also on Friday, even though, again, markets are closed here in the U.S., you're going to have Jay Powell doing a moderated session with a Q&A session. So it's very hard to say how the market will handicap these types of things with the market being closed on Friday, but one should be aware that going into Thursday, U.S. markets will be potentially hedging for risk event going into a 3-day weekend where you have the chairman of the Fed speaking and you have a major economic report coming out of the U.S. When we swing over to things like currencies, I thought we would start off today by looking at something different today, which is the U.S. 10-year versus the German 10-year. And the reason why we're starting with this is, first of all, when you look at the spread, you see what looks like a bull flag that's formed in the spread between the 10-year in the U.S. and the 10-year in Germany. And the reason why this chart I think is important is because it can tell us a lot about where the euro is going to go. This is basically a chart of the euro inverse. So in this case, I quoted U.S. dollar, then EUR. And so that gave us this relationship. And you can see how basically changes in this spread have resulted in changes in the euro. And so if this is a bull flag and we are about to see the spread between U.S. and German 10 years widen, then it seems likely to me that you're going to see the dollar strengthen versus the euro. And you can see this is a bull flag. There is resistance with the spread up here at around 2.06. And so this is something that I think is pretty easy to monitor and to keep track of. And it may give you a heads up and a leg up in terms of where the euro is going to go, because clearly the euro is just continuing to consolidate here. It's looking more and more like this is some sort of diamond reversal pattern. You have several waves of touching higher and lower points. We've certainly been consolidating some. When we look at it on a Bollinger Band, we're sort of nicely right in between those two bands. So not oversold, not overbought. Momentum clearly pointing lower. If we see those spreads widen, like I noted, then I think you're likely to see the euro break down and head to this 106.9 region and potentially lower to 105. And depending on how wide that spread ultimately gets, you could be talking about a situation where the euro actually retraces all the way back to parity in the near term. When we do the same thing with the US 10-year minus British 10-year, it's a similar sort of setup here where, again, if you're going to see the U.S. dollar potentially strengthen against the British pound, where the U.S. dollar versus the pound goes tends to be reflected in changes in this spread. It's not always perfect, but again, it can give you a sense of things, and anything in this market that can give you the slightest bit of an edge certainly is worth keeping a track of. And so if we were to think that, then potentially we could be talking about the pound breaking down below this 126 region, potentially heading back to 125, and depending on how wide that spread ultimately gets, potentially resulting in a return to the lows here back from October. Also, it is worth noting that this is not even overbought or oversold at this point. When we swing over to the yen, it's been a little bit confusing the last few days with the yen. It seems like the BOJ really isn't giving very clear information regarding what they're thinking about in terms of future monetary policy. So right now we've had this big sell-off going into the BOJ. We had this big trend reversal following the BOJ announcement. And now you have what looks like consolidation in the yen-dollar relationship, potentially heading towards a breakout here, potentially pushing even higher. This has also basically been a story of the spread. So we're going to want to watch this, just because what we've seen happen the last few days is a little bit of a divergence here, where you're seeing the spread actually return lower. And if it is the case that this relationship is going to continue to work, if we start seeing the spread contract between US 10s and Japanese 10s, then you're likely to see the yen begin to weaken. So pay attention to this level here at this 150, 170 area. This is obviously an important level. It goes back to the highs that we saw in October of 22. We know that the government officials have been sort of jawboning a little bit in the end, talking about it looking a little speculative, and so this is important to keep an eye on as well. Obviously, a breakout could send this to new highs here in this cycle, obviously, while a drawdown would look like we'd probably come back to 146.23. When we look at overall, when we look at U.S. rates, now remember, just because spreads are going higher doesn't necessarily mean that the individual bond rates are going higher and lower. In fact, what could happen here, if there is a case where spreads begin to widen, it would most likely be because it could be because U.S. rates are rising faster than German rates, or it could be that German rates are falling faster than U.S. rates. And a lot of that's going to depend on the economy and what central bank policy is likely to be. Now, again, we've been testing this 433 region on the 10-year, haven't really been able to break through it yet. Haven't really, you could still say we're in an uptrend, potentially forming an ascending triangle here. Certainly looks like we broke a downtrend. Certainly looks like momentum is positive. And so we would think that if we got stronger U.S. data here in the U.S., it could lead eventually to the breaking higher, although to this point it's been a big dud. We do have a 7-year auction coming tomorrow at 1 o'clock here in the U.S. It's sort of the same setup for the 7-year, with essentially the 7-year trading higher and 435 being key resistance. When we swing over to the FTSE 100, I thought this was interesting because the FTSE appears to be a little bit overbought right now. You're trading outside the upper Bollinger Band, trading above 70. Typically, when we've seen these patterns in the past, as we've talked about, it's been an indication of an overbought condition. It's typically led to some sort of consolidation. You're seeing that there's some decent resistance in the 79.30 region. So I wouldn't be surprised to see the FTSE sort of consolidate a little bit around this level. It doesn't mean it has to trade lower. It just means that it could just trade sideways and consolidate right below resistance, come back inside the Bollinger Band, have the RSI cool off a little bit before that next pop higher. But ultimately speaking, this looks like a good spot to take a pause. Support would be down here at 77.85. When we look at the DAX, it's the same setup here. RSI nearly sort of going out into space at currently 85.25, so extremely overbought, similar to what we saw back here in December. Here you can see we're also trading above the upper Bollinger Band. We've now had a 78.6% extension off of this wave right here. So this has gone a really long way. Clearly all-time highs. Again, like the FTSE, we're kind of at a consolidation point. One would think that there'd be some consolidation here. A 100% extension mark, though, you have to go up all the way up to 18,735 before you would hit that 100% extension level, which could be a meaningful level of resistance if this should carry. But again, it looks like you're getting pretty stretched right now, and a pullback to the 20-day moving average probably isn't out of the question at some point in the near future. S&P 500 the last couple of days has been getting beaten up in the final hour of trading. Again, it's sort of important to pay attention to these auctions. I'll just show you a good reason why. So today we had a 5-year auction that came at 1 o'clock in the afternoon. The auction went fine. The results were good. But basically, here's your 1 o'clock auction price. But if we layer in the VIX 1D, what you'll see is what sort of happened, and that sort of set the tone for the afternoon. If you can see right here, the VIX 1D actually traded higher as we went into that 1 o'clock time slot, and that took the S&P 500 off the highs of the day and really sort of reversed it and got that selling pressure coming into the day. Then there was a very large sell imbalance, which pushed the index lower. So this is sort of a reason why you want to pay attention to these auctions that are happening at 1 o'clock, because there is hedging activity that goes into them. And that could certainly kind of sway the market. So this was a very steep decline going into the close. You can see we had something similar yesterday. So not uncommon sometimes to try to gap higher. Again, this sets up a resistance level for tomorrow at 52.30. A break above 52.30 obviously breaks this downtrend, probably sends the index on its way to this upper trend line at 52.84 at some point later this week or next. Likewise, a failure to get beyond resistance here at 52.30 or to break this trend line, probably not a good indication. A gap lower, also not a good indication, with a return to probably around 51.75 or so, which would also take you to this lower trend line in this broader channel that we've had created now over the last couple of weeks. When we look at the Dow, we had a weak trading session here as well. Basically, we tried to rally, weren't able to really do so, finished the day 8 basis points lower. But again, this is sort of an important spot here at 39,280 because this could invalidate the new high. It could even signal we're in some sort of trend change. We'll just have to keep an eye on it. But a break lower sets up a return to 38,872, while a move above 39,400 probably sets up a return to 39,625 and then 39,870. And finally, when we look at the NASDAQ, we have this giant megaphone pattern that's been in place now really since, I don't know, I would say around the middle of January. Usually, in my experience with these megaphone patterns, is you get 3 touches on one side and you get 2 touches on the other side. And when you come down for the 3rd touch on the lower side, in this case, that's the time that you break. And we're going to obviously have to keep an eye on this. But we've also had a situation where we've had 3 touches to the upside. And then on the 4th attempt to move higher, it looks like you're failing. And that could be an indication of a market that's beginning to turn over. It's going to be a slow process because we still have to erase the gains from the post-Fed meeting, which would potentially mean that we'd see the NASDAQ drop to around 1850 and then potentially drop to 17,850. And there would still be quite a distance to go here. Meanwhile, if we clearly break out and break this downtrend and are able to take out 18,406, then it would seem to me that the next obvious place for resistance would be, again, at this trend line somewhere in this 18,880 spot to the upside. But we'll just have to continue to watch to see how this develops over the next couple of weeks. I guess the one final takeaway is that if the dollar breaks out because spreads are widening, that's probably going to be an indication that the stronger dollar in itself could be enough to sort of weigh on equity markets as financial conditions tighten and potentially sort of drain some excess liquidity out of the system. So that's something to be mindful as well, those interworking relationships that exist between the dollar rates and equity markets. Anyway, hope you have a great week. Hope you have a great holiday, and we'll see you next week. Bye.